All right. Hey, everybody. Welcome all my live video viewers. We're going live on Facebook and YouTube before we start the broadcast for the podcast recording. Here with Mark Maurer. Mark, welcome. Good to see you.
Hi.
Mark
Thanks,
from
Michael.
LLIS, who is with an insurance company that I promise will make it sound more interesting than just an insurance company. It's actually a very unique insurance company. They work specifically with financial advisors like me and are a great partner to financial advisors as well in serving our clients. And we're going to hear more about Mark and more about LLIS. And specifically, we're going to try to make life insurance a bit interesting today by pinpointing a few common mistakes or missteps that most people seem to make that we're going to try to kind of unpack and help with. So we're going to start off the music here for the podcast recording here, and we'll get things kicked off. So stand by. Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, independent financial advisor and owner of Elevation Financial. Thanks for joining us today for this episode, kicking off the month of August, which is the insurance-themed month, at least at Elevation Financial, my business here. So throughout the month, I like to really highlight insurance, education, different product types, different needs, different benefits, unpacking the details about insurance. And what better way to kick off insurance in this month with life insurance? Sorry, I really stumbled over that. What better way to kick off life insurance than with the month of August than with life insurance, because it's pretty important to many people. It's a product that is kind of fundamental to a lot of financial planning and a lot of life planning in general. And I'm happy to be joined today by Mark Maurer from LLIS. LLIS is an insurance company we're going to hear a little more about, but specifically from Mark, we're going to kind of introduce Mark here, and then I'll have Mark tell us a bit more about himself as well. But sometimes tradition is a good thing, and Mark Maurer is living proof. Mark joined LLIS in 2003, assuming the role of president in 2008 and CEO in January of 2013. As a son of insurance experts Keith and Judith Maurer, Mark grew up in the insurance industry and has an impressive combination of education and mentoring. He constantly monitors the insurance and financial services industries, and under his leadership, LLIS continues to expand his portfolio of solutions and services. Mark's dedication, along with his unique industry perspective, education and experience, allows him to build upon the LLIS traditions of cutting-edge information and customer service that fee-only financial advisors and their clients have relied upon since 1992. Were you chuckling because it's so hard to hear your own bio?
It really is. It sounds like that's about somebody else, not about me.
I'm the same way. When someone's reading my bio, I'm like, oh my goodness, that's so like uncomfortable to hear all that. But it's a really great background, and it really speaks to your professional life, I think, very well. So thanks for sitting through that. And I'd like to turn the time over to you a little bit as well to say, tell us more about the more fun facts, more things that aren't kind of in the buttoned up professional bio. Tell us about you.
Oh, sure. Well, and I think at least we'll talk somewhat insurance. Going back a number of years, I was working in Gainesville, Florida. I was a natural gas trader, and at some point in time, Keith and Judith, who I call mom and dad when we're not in the office, started to look not necessarily at retiring anytime soon, but looking for a succession plan. And as the story goes, they were driving home from work one day, and one of them said, we should ask Mark. The other said, oh, he won't be interested. Well, the first person said, well, but we've never asked. And, that was however many, going back on the bio, 2003. So 17 years ago, we had some conversations, and here I am. And I love it. We have 20 some odd people when we're in the office, which is kind of a loose term right now. I'm, technically in the office, but I keep saying I finally have made it. I have the corner office with a private bathroom. It just happens to have, the guest bed in it and a dog that sleeps on the bed.
That's a great office. I think many people are realizing how comfortable and convenient it is to be working at home.
It really is. It's you just have to remember to get dressed up almost every day. That was a mistake I made the first day. I just thought, oh, I'll wear my workout clothes to work, and it lasted one day. I've got to get up, shower, get the collared shirt on like I'm going to work.
Well, what's funny?
That was my trick.
Work attire has gotten a lot more relaxed, I think, these days due to COVID and virtual work. I mean, maybe not in the insurance industry as much, but I've seen a lot of people, the work uniform has gone from suit and tie to, maybe a shirt like I have on, kind of just a general button shirt, or even like jeans or t-shirt. So I think it depends on the industry, but I'm seeing a lot more relaxation of the traditional kind of dress attire. I don't know if you've seen that. That's kind of what I'm
Oh,
noticing.
well, we're in Tampa, and so I've never made anybody wear a suit. I wear a suit about 3 times a year because even, November, December, it can still be in the upper 80s. So a suit and tie, I do it when I have to.
It's just not practical. Yeah.
It's really not. I keep trying to go for the seersucker suit, the Matlock ensemble, but
Yeah.
I haven't quite gotten that
Gotcha.
far yet.
Any other fun facts about yourself you want to share before we jump in?
Ooh, I was going to say, try to think of my hobbies or activities, but I don't have a whole lot at the moment right now.
Family, kids, and you've got a son who plays soccer, right?
Yes. Yep. My son's 12. He plays soccer. My daughter's 10. She is really into ballet. My wife, Leah, started working in our office, helping with payroll and some of the accounting. And she's taken on a project of monitoring older policies that we've helped people get 10, 15, 20 years ago, and just working on a project of making sure they're all in shape and making changes to those now. It's a lot easier to change trajectory when you have 20 years as compared to 2 years.
Yeah. Well, it's cool. A family business like that must be really interesting, really kind of fun to work in. It sounds like a great tradition and a lot of family involved, and it's probably a lot of fun.
Yeah.
So let's jump into life insurance. We're
Okay.
talking about life insurance today, and my first precursor question I did not prep you for is, do you have any tricks for making life insurance sound interesting?
I always say if my wife worked for the IRS and we would go to any party, we could clear a room. She works for the IRS, I sell insurance, boom. But honestly, there's a lot of at least to me, a lot of really neat innovation in the last few months around life insurance, because we're used to getting everything we want from Amazon, Amazon Prime in 2 days. And the life insurance process has always kind of been this multi-week, multi-month thing. And a lot of insurance companies were starting to look at ways of, how do I use big data and get people's driver's license, motor vehicle records, prescription database information, and maybe be able to offer people policies without having to do the traditional paramed exam, where a nurse comes out to the house, gets a blood sample, a urine sample, gets your height and weight, and asks a lot of the same health questions. So there are a number of companies that were starting to make strides in some of that within the last few years. I think with COVID and people not necessarily wanting somebody to come to their house, a lot of companies were kind of thrust into this to say, how do we accelerate that, and how do we get to a place where we can still get people life insurance, make people offers that are still, sound business offers, maybe without having to do a paramed exam, because every time a paramed examiner would come out to a house, the insurance company pays for that. And a lot of companies were looking to say, okay, for younger people, if they don't have a history of driving issues, if they don't really have a prescription, anything show up on their prescription records other than maybe a Tamiflu or something, how much more are we going to gain by getting that additional information, where the costs involved with having somebody come out to do a paramed exam, if we can get their doctor's records, they saw their physician within the last year or two, they had blood work, can we take the available information and not have to do those expenses, especially now knowing that no one really wants to have a paramed exam if they can avoid it. So some companies who had a process may have increased the amounts they were comfortable with. Some companies who didn't have a process quite yet, I think, really ramped up how they were, bringing that to market, so that most companies today have some sort of program where they are trying to do that, get that part where they can make an offer of coverage without having to do a paramed exam, and try to do a little more of it, behind the scenes.
Yeah, you're really streamlining the process. That's happening forward in a lot of ways nowadays, which is great for people, for consumers. Absolutely. So,
absolutely.
Yeah, and what's cool about LLIS is you're a bit unique in you're an insurance company, but you will work with the general public if asked, but your model is really to work with financial advisors like me, and so you have a network of financial advisors that you partner with, and fee only advisor specifically, I believe,
Correct.
like I am.
Yes.
So there's no commission, there's no, referral back and forth. The advisor just simply, wants to have a source to recommend great products when it comes to insurance to their clients. And so I really love having LLIS as a partner, because I'm able to say, hey, if you need a great source that I trust, that I can kind of be in the loop on, I can kind of, partner in the communication with and the recommendations. That's where LLIS really fits in really well. And you've served a lot of clients of advisors for a long time, which I really appreciate. So thank you for that.
And it's a great group of people to work with, because as fee only advisors, you're just looking out. You have the fiduciary standard. You're looking out for the best interests of a client, and you wouldn't be recommending life insurance if they didn't need it. And so it's a great group of people to work with. That it's not a lot of upselling or trying to get the newest and the fanciest. And a lot of times I'll have clients ask me, "What about this rider or that edition of the policy?" And I usually tell them we don't recommend them. We're pretty plain vanilla. You can add lots of different riders to do lots of different things, but mostly the basic, especially in life insurance, the basic term policy is going to be the best fit, and the money that you might spend for the other riders are more of a, well, if this happens, then this might pay out. Rather go for the straight just life insurance.
Yeah, right on. So speaking of life insurance, let's hit these three. I jokingly call them mistakes, but and that may be too harsh a word, but I like to say mistakes because I see them a lot. I see that there's these three issues or mistakes or missteps that kind of come up over and over for a lot of people. So those three are underinsuring, 2, buying life insurance through work, and number 3, buying cash value life insurance when it's not appropriate or when you don't need it. I see those three come up a lot, and so I'd love to talk through those 3 points with you, starting with underinsuring. I see a lot of people that are underinsured. And so I think a 2-part discussion I'd like to kind of hear you jump in on is, first of all, what is your definition of the purpose of life insurance? Why do you have it and when do you need it? And what is the appropriate amount? And how does what kind of gap is there between that and what people usually end up with underinsuring?
Okay. The main crux of life insurance is that you want to leave somebody money when you pass away. And that's really the main idea. If you don't have anybody who you care if you leave money to, then there's no reason for life insurance. And sometimes I will see single people who have no kids, no particular need for life insurance, who were sold life insurance from somebody. It might be an old friend from college, but you have to look at it and say there's no loss to anyone if this person died. Now, and sometimes that sounds callous. A lot of people might be sad, but there's not a financial loss if somebody dies and wants to, they leave their parents a life insurance policy. Unless they owed them money, there's not a real financial loss. So it's a financial loss. There's 2 types of life insurance, and I'm going to really oversimplify, but you have term insurance and permanent life insurance. Term insurance is for a period of time, and by far and away, the most common reason you have term insurance is to protect your income. And so you may have a $1 million term policy and you can lock in a premium for 10, 15, 30, maybe even 35 or 40 years. And the reason you would have that is that it's going to have an end. So it has a term, it has an end, because I want my income earning years to have an end. And sometimes I phrase a question, when do you plan on retiring? And I'd say 30% of the time I get the answer, well, I'll probably never retire. And then I have to go back and say, okay, I need to rephrase. When do you think you'll be financially independent? When do you think that you won't need to work? Oh, okay, 65. Great. So we're going to look at a term policy that replaces income between now and age 65. And when you get to 65, you hope you don't need it anymore. The policy, now you can trade it in for permanent coverage. There are some options you can do with it, but really you're designing it to have a lot of coverage for a short period of time and keep the premiums low, so that any money that you're saving by using term can go into investments and savings, so that when you get to 65, you'll be financially independent. The other type is permanent life insurance, and this can have lots of different flavors: whole life, universal life, indexed universal life, variable universal life. But this is really about a legacy, and this is really about permanent life insurance, it being there when I die, no matter when that is. So If you want to make sure that your grandkids get $250,000, you can't do that with term. You might, but you'd have to die in the period of the term, where a whole life policy or universal life policy lasts for as long as you do. And so that's a legacy kind of design. It's that's more of a need or a want or a desire necessarily than a need, like term insurance might be for the primary breadwinner in our family with a stay-at-home spouse or work-at-home spouse and 2 kids who, if they didn't have the working spouse's income, would be significantly impacted.
So I've noticed when most people, I shouldn't say most people, I've seen a lot of people that sign up for insurance, maybe it's through work, which we'll get to in a minute, but they sign up through work or they kind of a default amount, and it's like, $25,000, $50,000, maybe $100,000, and they think that's enough. Is that enough?
No. No, period. That's an easy one. So most insurance companies, and that's a wonderful thing about working with a family advisor, is you all are going to take a look at their income, their assets, all of their whole plan, and say, what happens if spouse A passed away today and you lost $50,000 of income over the next 22 years? How does that impact everything? Using that number, let's say that's $1 million loss. And so you might need $1 million of life insurance today. I have sort of my 2 rules of thumb. My first one is 10 times earnings. If you have a family, 10 times earnings, I think is almost a minimum. If you're going to retire next year, that's a whole different thing. But anybody with kids, with children, 10 times earnings may not do everything you'd want to do. It may not replace all of your income, but that would leave enough of a cushion to get things figured out for a few years. You wouldn't necessarily have to worry about losing the house, and there might be some money for college planning. Then, there's multiples of income. If you very super non-scientifically take the number of years that you plan on working and take your income today and multiply the 2, that's a reasonable number too. And then, of course, by working with family advisors, then you have access to a lot more sophisticated planning software that's going to narrow down probably some number in between those 2.
Yeah, how much debt you have plays a part sometimes. If you have a lot of debt, that kind of can get stacked on top of the need, in my opinion. So, hey, that's a really good spectrum of the minimum being 10 times income plus other factors that might drive it up a little more.
Right.
So.
And you that was a good point. So I talked about usually for term insurance, it's income replacement. There may be other scenarios where somebody owns a lot of real estate, and so you have an income replacement need, but you also own $3 million of real estate that has $2 million of mortgage. You may want to add a second policy that covers that period of time for the mortgage and an income replacement, because even though you may be able to pay off the mortgage, it wouldn't help the day-to-day being able to pay for groceries necessarily unless you had to sell the land.
And here's the thing about insurance. When people hear 10 times your income, they're thinking, oh, I need like $500,000 to $1 million minimum. That sounds like a big number to them, but it's really not very expensive at all. Term insurance especially is extremely inexpensive. And so I think a lot of people are pleasantly shocked by how inexpensive it is to get even $1 million in coverage typically.
Mm-hmm. Right. And when you look at somebody late 30s, early 40s, $1 million of 20-year term, I'm still always amazed by how low it is sometimes. We're talking less than $100 a month for $1 million of coverage for people who are in reasonably good health. I think we all think of, we've seen whole life policies or had somebody show us a whole life policy where the premiums are maybe $500 a month, and that just seems like too much. But good old term insurance, you can get a lot of coverage initially when you need it. Sometimes we even look at layered term policies. So maybe if you need $1 million, $500,000 for the next 10 and 20 years, so you have $1 million of coverage for this period of time, and then it decreases and levels off. Sorry, doing my hands backwards. I give up. I was looking at I should have just not even looked at myself. So you have $1 million now for the next 10 years while your kids are youngest, and then it drops off in 10 years because you've lived and you've had 10 years of income behind you. So now that you're 10 years closer to retirement, maybe you need less life insurance because you have fewer income years ahead.
Yeah, you have assets built up. You
Right.
start
Exactly.
to insure gradually as you get closer to that financial independence number, which is why term insurance is typically not necessary for life, for a permanent period of time. So
Right.
and then you have options. So the idea, one of the practical ideas behind life insurance is if you die and leave your spouse behind or your family behind, and you have 10 times your income, let's say it's $1 million, your family can then invest that money and produce income from that money. Maybe not total replacement, but at least somewhat of income replacement based on return of investing that money. So that's
Right.
part of the practical application of what happens in the unfortunate event of that death.
Right. Exactly.
All right. So good background. So bottom line, most people are underinsured that I've seen.
Right.
I'm making up the statistic when I say most, but it happens enough that I feel like it's a very common issue that people just don't have a sense of how much insurance is appropriate to really be effective. So that's one issue.
Right.
So number two, I love this one, buying life insurance through work. Many of us take the path of least resistance. And I've often seen that the path of least resistance for many is to just say, oh, well, my job is offering me life insurance, so I'll just check the box and I'll take it.
Right.
What are some of the issues behind that?
So there's generally 3 different layers of work coverage. Usually there's the first $50,000 that the employer pays for, the employee doesn't pay anything for, and that's great. Then there's usually a secondary layer that says something like maybe 1 time salary or 2 times salary that the employer pays for. So the employee doesn't pay anything, they just have to pay the tax on that premium. So your first one is free for everybody, so that's good. Your second layer is I'm only paying tax on the premium, not paying the premium, that's still good. Then you have the third layer that says, okay, if you want another 2, 3, 4 times income, we can do maybe a little bit of underwriting. We're going to ask you if you smoke. We probably won't do a paramed exam, but we can add that on. And that usually, one big aspect of that, which is that sort of streamlined underwriting. If somebody's in good health, it's not going to be a great deal because the insurance company is sort of bundling in everybody to say everybody's paying one rate. If you're 42, you and Bob and Jim and everybody else who's 42 in the company is going to pay the same premium. And you can look around and you can go, ooh, Bob and Jim don't look that great. I should probably be paying less than them. So going out and applying for individual coverage where there are different rate classes, you can have that exam. You can say, I don't smoke, chew, I exercise, I'm a good build, and maybe get better rates. Conversely, if you're not in great health, Bob and Jim might be really excited about this plan because they looked around and said, it's kind of pricey out there. This policy is a good plan. And so depending on the different person, it may or may not be a great deal. I can't remember if I'm on my second or third part, but the third. So the other part about that, so part 2, there we go, part 2 of the third layer. Ooh, it's too much math. Part 2 of the third layer is that those rates are going to increase, and they increase every 5 years. So somebody between 40 and 44 is going to pay one rate. Once you move to age 45, normally the rate goes up 20, 30, 40%. Now you pay the same rate for the next 5 years, but it's stair stepping. And so you can get the coverage when you're in your late 20s and it looks really inexpensive. And like you said, the path of least resistance, it's just going to come out of my paycheck for the next 20 years. I'm not really paying attention to how much it's increasing or what it's doing until you work with somebody like you and you take a look and say, what's this $236 every other paycheck for life insurance? Oh, that's my group. And you look at it and you go, that's an awful lot. They didn't really notice. It's just been increasing every few years. It's coming out of the paycheck. So, most of us, we spend what comes out of the paycheck. We don't necessarily look at what, came out of it before it came into our bank account. And so you can, again, healthy, even moderately healthy people can get new coverage by applying on their own, and you can lock in a rate for the next 10, 15, 20 years as compared to having this policy through work that increases. And the policy that you own yourself, you own it.
That's the
Usually,
part
that's the big one.
important to me.
That's the big one. When you leave your employer, you generally don't have any option to keep it as term. You may have to convert it to whole life, and we're talking premiums are going to go up 4 or 5 times. And so you have very, very few options or expensive options, or they're going to be expensive options if you leave your employer.
And here's the issue with that as well. So let's say some people are probably thinking, well, okay, I'll just get it through my employer, and then when I leave, I'll just buy individual. But the price goes up as you age. So if you're with your
Right.
job for 5 or 10 years, and then you lose your life insurance and have to apply for a new policy, that price, so the premium has gone up when you could have locked it in with an individual policy 5 or 10 years ago.
Right. And we're assuming that my health hasn't changed
Right.
in the last 5 or 10 years too.
Right. So locking in early is really important
Right.
when it comes to life insurance. So, all right, awesome. So I always like to encourage people. There's 2 types. We're not talking about disability today, I know, but there's 2 types of insurance that I generally recommend people strongly consider buying individual in this life insurance and disability insurance. Those are really important types of insurance to have that you own directly, privately, that are portable, that go with you wherever you go, and that you own directly. And
Exactly.
this is a big one. So thank you for talking through that one. All right, third. Now we're gonna keep this short because this could be an 8-hour conversation, which we're not gonna make it because there's a lot of controversy around this. But let's talk about cash value life insurance or permanent life insurance, as you mentioned. There's different names for it. There's so many. How often do you see people buying cash value or permanent life insurance when they don't need it?
How often? Pretty regularly. And if we go back 40 or 50 years, we didn't have 529 plans. We didn't have 401ks, and maybe even longer than that. But a lot of the IRAs, things that people have the ability to save in now, didn't really exist. You put your money in the bank with a CD, or you put it into a life insurance policy, your whole life insurance policy, and that was where you put your money and saved your money to take money to pay for colleges, to take money for retirement. The number of ways we had to save money were much smaller. Your average person didn't dabble in stock markets or have an online Vanguard or Fidelity account where you can take a pick of 5,000 different mutual funds. So it was designed to do all things, and it can build cash value. It does have a life insurance death benefit. Money grows on a tax deferred basis. All of these things are true, but the premiums for it are going to be much higher than a term policy. And when you pay into a whole life policy, for example, you generally have 8, 9, 10 years before your cash value is equal to what you've paid in. And so as a quote unquote investment, it takes a long time for it just to break even. But it does have the death benefit component, and it does have some savings component. But it's kind of like trying to find a fuel efficient Humvee, or something that tries to do all things. It's never going to work. A really cool looking Prius, it does, you just can't Prius, it goes from 0 to 60 in 3.2 seconds. You can't do everything. So when you say it's a savings component, it's life insurance, it can work okay at both of those, but not necessarily very well. It can't excel at both. Otherwise, it would be the only thing that we'd all do, and it would all work for one big insurance company if that truly was the best investment out there. So it's generally sold to people. It just depends. But I'd say a lot of us would say, I'd like to leave something to my kids when I die. Who's necessarily going to argue with that? But then we can argue that a better way to do that is to have the term life insurance, save up your money, have your assets grow, so that you're at a point in time where you have enough money in other assets that you can leave your kids something else. And again, for me, because a lot of advisors we're working with are, in a scenario where a lot of their clients are, have young kids, have money competing for all kinds of different expenses, college, retirement, all these other things, to say we're going to cut the insurance premiums by 80%, and free up this money that can start going towards these other goals you have, and maybe even increase the amount of life insurance you have, is pretty neat to be able to do.
Yeah. Yeah. So and there are, I mean, nothing's a blanket, generalization across the board. There are specific cases where, a cash value insurance policy may make sense, but for the vast majority of people, especially I've yet to see a case where it does make sense. All of my clients are appropriate fits for term life insurance, and the vast majority of people, they need term insurance. And like you said, the alternate investment options are more appropriate for them, more traditional things like a Roth IRA or investment accounts that kind of build value and leave an asset behind. So for us, it's important, I think, for people to understand the distinction, because often it's difficult for people to really understand what they're being sold. They just say, oh, life insurance. I don't know what the difference is. This person tells me I need life insurance and here's how much, and I'm going to sign here. But that's all they really understand. And so the difference is term life insurance versus everything else, really. So when you're looking for life insurance, the vast majority of people want to strongly consider term insurance. And all the other stuff, if it sounds complicated, like universal life, whole life, variable life, cash value, permanent, that's an indication that you want to dig deeper, because it's likely a cash value or a permanent life insurance policy. So thank you for the clarification on that as well. I know a lot of fee-only advisors like to slam cash value, which we won't do today. I'll refrain.
Well, and like you said, there are going to be scenarios where it makes sense, and estate planning. It may be estate tax planning, which right now you have to have just crazy amounts of money to have an estate tax. But somebody may own a farm and have 2 children, and one wants to work the farm and one doesn't. Permanent insurance can be a way to sort of equalize an estate, equalize an inheritance. Another time we look at it probably fairly regularly is clients with special needs children. You have this need that while both parents are alive, they're caring for this child, and things that we do as parents for basically absolutely free. But if both parents were gone, now you need maybe a lump sum of money to be able to have the special needs child live with a sibling or pay for care. So there are those sometimes needs that may not end right when we hit retirement. We think retirement funding and sort of our own debts, those are pretty normal for term. But there are those scenarios that aren't necessarily people with $20 million estates.
Yeah, fair enough. There's rarely not a one size fits all. So.
Right.
It's been great. Thank you for unpacking those points. Is there anything you want to go back to? Anything we haven't covered in those 3 points: under insuring, buying life insurance through work, or buying cash value insurance? Any points we've missed?
No, I think I hit my notes as I was going through all this, and so no, I think that's pretty good. But again, we're working with a fee-only advisor to help with the nuances and the different types and what somebody has, and that's something that we do for fee-only advisors. I do every day. An advisor will send me a list of a client's existing policies, and we take a look at, here's what they have, here's what they're paying, here's what we think may be a better fit. How do we repurpose these, make changes to it? Sometimes it's keep what they have. Sometimes it's to be able to say they have these 3 little whole life policies and we can do a lot more term for less money, because really what they need is income replacement, and just find ways to work with advisors and their clients with existing policies to see if there's a better fit out there.
Right on. Well, you joked before we started recording that you could talk about insurance all day, and I'm impressed. We've kept it to about 30 minutes so far, so I think we're doing well.
Well, good. You didn't ask me to start going into individual disability coverage, because then we'll be here another half hour.
So one last question for you. Obviously, we've talked about insurance specifically today, but that is a critical component of protecting and building wealth when it comes to a holistic financial plan. So what does wealth mean to you?
I imagine this is probably a fairly standard answer, but to me, I think it's freedom, the ability to sort of pick and choose what you want to do and wake up any day and do. I'm very lucky. Like I said, I still work with my parents. I talk to when we're in the office pre-March, I eat lunch with my dad most days. And I'm very wealthy for that. There's very few people who get to do that. And just to be able to do what I do every day with people I like, feel like I'm making a difference, helping people. And many times there, like I said, with the policy reviews, there may not be anything that we do that will help because someone's not in good health anymore. But to be able to work with the advisor and client and say, here's some ideas that you keep the existing policies. You couldn't get new coverage today, but here's some ways to redo this policy so that it's less of a premium impact to you. That's really neat. And I think that makes me wealthy too, just being able to help people, especially because insurance sometimes gets a bad rap. And I just try to imagine that if somebody, if it was my parent going to, or my brother going to somebody, how would I hope that somebody else might help them?
Yeah, you're right. The word freedom does come up a lot when I ask that question, but I love hearing everyone's unique twist on the answer, because I think one of the misconceptions about wealth is it's a pile of money, and really in reality, it's not a pile of money. It's something unique to each person. And a lot of it does come up in terms like freedom and flexibility and the ability to spend time with loved ones. And I love hearing everyone's answer. So that to me sounds like wealth. I appreciate your answer. Thank you.
And someplace cooler than Tampa, Florida in August.
Tampa's not bad. It's a nice place.
If I could go vacation in the mountains right now, that would work.
Hey, you've got the ocean, so you've got that going for you.
That's right.
All right. Well, I know you can be found at LLIS.com. I know that you're a little bit unique and you don't really publicly advertise, but obviously you're on the website. People can find more about you there and even contact you there. And of course, you're for a client of mine. You're probably going to be working with Mark at some point on Mark's team. So it's a good way to find you as well. Any other information you'd like to share with our audience?
No, I can't think of anything right now. That's more life insurance than most people can handle. So
we'll put a cap
in anyone sitting anyway.
Right. Well, I really appreciate your time, Mark. Thank you so much for joining us today. And thank you to everyone who has been with us today for this episode. We appreciate you being here. You can contact me online at elevationfinancial.com and have a great day. We will see you next time. All right. The recording is off for the audio version.
All right.
Everyone who joined us for the video version. And obviously we'll post this is posted on Facebook and YouTube, and we'll go out on the podcast episode as well. So thanks everyone for joining us via video as well. And we'll see you next time.